You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. You can almost hear it in the headlines already. Margins fall, orders slow, affordability crushes buyers. And just like that, Wall Street decides the housing story is over. But I'll say this loud, and I want it to echo. The data doesn't lie, but the headlines do. Today we're breaking down PulteGroup, Taylor Morrison, and Century Communities, three builders that just reported Q3 2025 earnings, three different playbooks, same market, same misunderstanding from the financial press and the headlines. Let's get into it. So let's talk about what's going on in the market. But before we dive in, I'm going to say I just had this realization, and I think something else is afoot here that maybe is a little bit of my conspiracy theory. Yes, I do fancy myself a little bit of a conspiracy theorist from a hobby perspective. But what if all of this gloom and doom and negativity in the headlines actually fuels the growth and conglomeration in the housing industry? Who does that benefit? Think about this. If you're into Wall Street, there's only two types of builders you can really make money off of. Publics, where you can buy and trade their stocks, or ones that take public money. Private firms, though, that like we talked about, New Home Company, not publicly traded, but they have public Wall Street funds. So when you look at the, let's say, and I think we talked about 50% of single family homes were by the top 20 builders. I believe that was 2023 numbers. 40% of for sale, I believe, is about the rough number by the top 20. The more that share grows, the more the big machine has overall control, okay? Now, when there's a negative headline and it makes it harder for the smaller, less capitalized regional or local market player, that proves advantageous for the big publics who have liquidity. Now, here at the Builder's Mindset, we have to focus a lot of our reporting on the publics because they put the data out. And we like to use it for our private clients to look at that as a benchmark, as a metric, as an index, right? And so just think about that. There could be an end result that negative headlines help the bigger machine in the long run because they can weather that storm, but it doesn't help the smaller guy. And for those of you who may listen, and I love having these conversations, and you know, most of my friends, people that I interact with, aren't really well versed in what I call the production home builder market. So when I say to them, yeah, I have a client who builds 300 houses a year, that is massive to them. They struggle to even get the concept of that. Then when I tell them, I've worked for builders who've done 1,000 homes a year in a single market, and there are builders who do multiple thousands in a market, tens of thousands nationally, it just blows some of their minds. So I and we here at the Builder's Mindset, we are fighting daily, weekly, monthly, for those small local builders to understand what they can do, the levers they can turn, and how they can think and operate more like those big guys. We're fighting for those guys who do less than 500 homes a year, who are trying to stay relevant and trying to not be another casualty of either a buyout or a closure because the market has a hiccup that extends. You know, back in the day, the oil and gas industry, right? Standard Oil, they had to break Standard Oil up at one point in time because they would do things such as buy all the land around another smaller guy's oil field so that they couldn't get in or out without getting an easement and paying them for that use of that easement. They would lower pricing across the street from those smaller competitors, and those competitors couldn't weather it. When the market gets like it is right now, where you've got 6+% interest rates, and you have tariffs, and you have land pricing struggling to really not making headway of easing off in any significant way, you have affordability challenges. Who do you think can weather dropping prices 5 to 10% and continuing to buy down mortgage rates from 6.5% to 4 or 5% longer? The big multi-$100 million, multi-billion dollar companies, and not the 300-400 home a year builders. But let's get into it. And we're going to also flip things around a little bit, because here at the Builder's Mindset, we tend to focus operationally, and we tend to, our focus tends to be on from the dirt up. We call it vertical construction, bricks and sticks, boards and beams. But what we're seeing here, when you look at these big operators, land is a big story right now in terms of how they are working into and working through this extended period of affordability challenges that's being attacked on all fronts. Let's forget earnings per share for a second. In this market, land is ultimately, it is the currency. Even though we here at the Builder's Mindset talk about it is not the single largest component of the revenue, it's not just about that dirt. It's about how they execute that dirt and the discipline. And we have said that we do acknowledge that if you make a bad land deal, you can't work out of that. If you plan a bad product, you can kind of work around that with reapproval of plans with planning commissions. You have a fighting chance if product is your problem of making adjustments. But if your land is your problem, you're kind of stuck. Because typically builders, they own that land. They own it where it is. They can't move the land. They can't change the value of the land unless they write it down, and that's a whole other story. But they're stuck with that land. And so how do they execute? Builders monetize the land asset by building a house on it and selling that house to a family or an entity. Okay? So PulteGroup pulled back land spend this past quarter intentionally. They walked away from options that didn't pencil, kept cash at $1.4 billion and debt to cap at near 13%. And Reuters reported that Pulte profits fall on weaker margins amid slowing home sales, but missed the nuance. They didn't retreat, they repositioned. That's how we look at it. They're making some adjustments. Pulte is known for and will always manage their margin. Taylor Morrison went the opposite direction. They renegotiated 3,400 lots, cutting prices approximately 8% and pushing closings out a little bit further. So they were reworking their cost ahead of time, even at the expense of that land coming online a little bit later. It's a really smart move. AOL reported and called it land discipline in action, and we agree. We think they're right. It's not weakness, it's leverage, and the sellers blinked first. Then there's Century Communities, who are sitting on 70,000 owned or controlled lots, enough to ride out an entire rate cycle. Tip banks called it solid Q3 with cautious optimism. They're playing long duration defense, but land control has a carrying cost. When incentives rise, those holdings start to burn. So we'll have to see how that plays out for them in the long run. Bottom line, land isn't a growth race. It's a psychological test. The smartest builders treat it like a chessboard, not a scoreboard. And there are different ways to attack it. Pulte can give things back if they've got enough land already. They can repurchase that land down the road. Or like Taylor Morrison, they can renegotiate. Or like Century, they can manage a lot of options and they can option that land so it's not really officially on their books, and they can kind of wait to decide a little bit later. So there's different strategies of how you do that, And it's all comes down to how and when and at what cost you officially put that land on your books. The margins tell a deeper truth. Margins are the pulse of control. And if you know where to listen, these builders are still strong. Look, Pulte reported 26.2% gross margins. Yes, that's down from 28.8% a year ago, but still strong. They guided Q4 to 25.5 to 26% margins. And NASDAQ confirmed that their earnings per share beat consensus even as orders dipped 6%. That's not erosion, that's precision under pressure. Pulte is known for protecting their margins, and they're doing a pretty darn good job compared to their peers right now. Taylor Morrison hit $2 billion in revenue, earnings per share at $2.11 a share, beating the $1.92 forecast. Investing.com and Simply Wall Street both called it profit beat with digital momentum. But summaries botched a key detail. SG&A improved 80 basis points, 80 bips year over year to 9%. That is solid in today's market. It didn't worsen, it got better. The arrow literally pointed the right way for Taylor Morrison, but the wrong way for the summary, in my opinion. Single-digit SG&A is something to be lauded in today's marketplace, and we talk about this. The market and the reporting and the headlines continue to focus on the negative, not looking at the deeper perspective. Average selling price at $602,000. That's not affordability collapse. That's Move Up America, where the margins still live strong. We talked about Toll a little while back. Like, they see where the market is. They're going for these well-qualified buyers who have good down payments, and they're playing into that marketplace. I think the numbers on the to-be-built and the second move-up, I mean, the diversified strategy that Taylor Morrison has been working, where they have first-time homebuyer communities, they have first move-up, they have their Esplanade and resort lifestyle, they also have what I would call some second move-up, really has played well into them to be flexible in this time, and it's really working to their advantage to be able to be nimble in the marketplace. Century, they held right around 20% home closing gross margins. And I would say anything in that market or above is solid. Their incentives still running about 11%, with a possible of going up 0.1% in Q4, as they said. But Simply Wall Street called that deterioration. But when you beat earnings per share expectations and keep profit in an entry-level market crushed by rates at nearly 20%, that's not deterioration. That is adaptation. These big performers are working through this cycle. It's funny that we've been in a non-down market for so long. We've talked about this in previous episodes. The home building industry kind of tends to be cyclical. 7 to 10, we'll call it the 7 to 10. What do I mean by that? In 10 years, there's usually somewhere between 7 and 9 years of good and 1 to 3 years of kind of rough or softening. And sometimes that market is, 8 years of good, 2 years of horrible. Sometimes it's 7 years solid, 2 kind of, or 1 coming down, 1 bad, 1 coming back up. But if you figured 2013 was when we came out and 2014 was really solid, and we've really been in this down cycle for about a year right now, we had a good solid 10-year good run in this market. COVID kind of got in the mix with the causes and whatnot of it. And it's really been, I would say, in the last 10 to 12 years, we've kind of been in this weird breaking the cycle that home building has typically been in. And there was an article recently where I think it was John Burns who talked about that we're starting to see less cyclicality in the industry. And part of that is because institutional investors are coming in and builders are figuring out ways to sell in the cycle, in the yearly cycle, right? So there's seasonality, and the seasonality is getting smushed out. I believe that those bigger builders, as we talked about earlier, who are able to weather these storms, I think they're figuring out ways to stream or sort of squish out the yearly seasonality as well as squeeze out the cyclicality that we see in that 10-year cycle. But the margins that they're able to maintain even these down markets is just, it's incredible. Once again, go back. For our clients who are smaller clients, this means tougher times for you in competition. So it means less room to sort of worry less about operational efficiencies, product, cost of product. You have to be firing on all cylinders. You have to be looking at every $100 you spend for a wider driveway, every $100 that you're going to spend, or $500 that you're going to spend on garage service doors, that extra window, etc. You have to be very, very careful. For those who are going to listen to this and say that I'm a cheap entry-level minded builder, I will say guilty as charged. And what I would say though is you have to parse out the difference between what I would say the sub 50 home a year builders who are typically custom and semi-custom and production builders. If you're 100, or let's call it, if you're 200 plus a year builder and you fancy yourself a production builder, you do not have room. There's a big difference between built to order and semi-custom. These big builders and production builders can still do built to order where they have a predetermined set of options, both structural and personalized choices, and let buyers pick and choose countertop colors, island sizes, etc. And they can leverage margin that way. We're talking about those builders, not ones who will let people blow out and do bay windows and expand footprints in square footages. That's so. When you rail on certain builders in the builder market and you say that they're cheap and they build crap and low quality, my argument to you is, do you have the experience and understanding of what it takes to run a company that's going to build 200, 300, 400, 500 homes a year? And what that takes to compete with those big publics that do that in your market? You know, think about this even. If you're a private builder building 500 homes a year, and one of your competitors is a top 10 national public builder that in your market they're only doing 300, I would argue they have better leverage than you do, even though you're building 200 more a year in that market, because of the supply chain leverage that they have nationally. So you don't have the liberty to overspec, overdesign, and underperform. So listen, let's talk about the media blind spot, and I think that's putting it mildly, because I do believe that the media tends to look for the things that get them clicks, because clicks are cash for the media. Because why? They sell subscriptions, they sell yearly memberships, they sell advertisements, and so it doesn't benefit them to put out articles that go deep, talk about what's really going on, and talk about how builder eroded margins for the long term aren't that big of a deal, and we shouldn't be overall concerned about the market crashing. Barron's wrote, investors are flying blind until Pulte reports. Now, I don't fully disagree with that, because Pulte is and was in this cycle the first one to report. But if we look at Toll and KHOV, who report a couple of months ahead of everybody else, then we look at Lennar and KB, and we're going to start doing that here at the Builder's Mindset. We're going to start doing a podcast once we got the Toll and KHOV numbers, and then another one once we've got the KB and Lennar numbers, because we believe that gives you a preview into what's about to come for the rest of the 15 publics that are gonna report. Then when they did, the same analyst said margins weakened, demand soft. That's not that's not an analysis. That's a copy and paste of panic. They're basically saying, gotta wait till Pulte puts their numbers out, and then they're gonna say, oh, their margins weakened. As we said, yep, their margins were down, but they were still 26.2%. They're not giving you the whole picture of the strategy that Pulte is doing to manage their margins and get through this cycle. Okay, here's what their transcripts actually said. Pulte cycle time, 106 days, fastest since 2021. That is operational execution at its finest. Taylor Morrison's building an AI-driven buyer system. That's forward-looking, just like Lennar is investing millions and millions of dollars into their machine. These are builders that are saying we have to continue to perform better, both, and kudos to Taylor Morrison, the buyer system. They're working on the front end, like Lennar reported, what they were doing. Their systems that they're developing and putting money into, which, yes, are impacting their SG&A, but is going to allow them to convert more internet traffic to leads to appointments. Leading indicators we talked about, they're investing in that. But that doesn't sell headlines. Century's incentives are a strategic throttle, not desperation. They're continuing to grow, get their land pipeline right to be ready to move forward. Look at their strategy. As we've said before, are they executing more efficiently, and is their execution in line with their long-term strategy? And I would argue even Century, who has the lowest margin of the three we're talking about today, with their Century and Century Complete model, which is focusing very heavily on entry level, they're doing the right things and staying true to their strategy. Momentum isn't about speed, it's about control and movement. Momentum is mass times velocity. So if you have bigger mass at a slower velocity, you can have more momentum. Think about it like this: a freight train moving slowly, but it still keeps moving down the tracks, and it takes a long time to slow it down and or stop it. And control is exactly what all three of these builders are showing. Let's talk about the politics of confidence. Let's get real and political. The Fed designed this environment to test nerve. Every rate hike is a psychological choke point for the buyer and the builder, but the best players aren't waiting for Powell's permission. They've seen the writing on the wall. These quarter point rate drops, they're just talk. Yeah, do they move things a little bit, increase traffic a little bit? Yeah, but they're really not going to move the needle. The big builders have accepted the fact that rates over 6% are here to stay. Pulte, Taylor Morrison, and Century have become their own central banks, for lack of a better description. They're managing their own liquidity. They're flexing incentives as they see fit to move their momentum and keep their pace where they want it. They're renegotiating land. They're pacing starts like monetary policy. That is not reactionary. That is revolutionary. I think, once again, I'm going to call this, and if you're a small builder, let's talk offline. These big builders are making changes right now, and they're adapting in the infrastructure they're investing in from a AI and software perspective, how they're negotiating and leveraging land, how they're negotiating and leveraging their long-term strategic partnerships on supply chain, how they're leveraging and executing their sales pace, both on front-end appointment numbers and incentives and price reductions. They've got this dialed in. We talked about this in a previous episode. Wait for the first builder that launches an AI-driven sales tool that essentially has a buyer come in and sit down. We take their down payment number, we take their credit score, we take their desired home square footage and bedroom bathroom count needs, and we are, as a builder, able to tell them what is the best thing for them as it relates to, we talked about the levers builders can leverage. They can lower base house price, they can buy down your rate, they can give you incentives on your personalization and options. When a builder can make an offer to a buyer based on what that buyer's wants and needs are, that are going to maximize the margin, because we've talked about this. When you look at those three levers, base house price, margins on options, and giving away free options, incentivizing on options, and buying down a rate, every buyer is unique in terms of what they need and what is going to provide the best margin for the builder. I forecast that within the next 12 months, at least one, if not more builders will have this mechanism where a buyer will fill out a form online, and when they walk in for their appointment, we will know exactly the best offer combination of those three metrics to give to them, those three incentives that will make them convert and maximize the builder's margins. So let's get real about this. And so while policymakers debate affordability and they talk about nothing but land, builders are out there rewriting the rule book on stability and profitability. And at the end of the day, the profitability is like an index. There's a bandwidth, right? And yes, over the last 3 years as we ran through COVID, that was somewhere between 20 and 30%. Well, now I think the new normal is somewhere between 15 and 25%. And we want to be closer to 20, not 25. Get ready for that and get ready for these big builders to continue to execute. And if you're a small private builder, you better get your ducks in a row or you're going to be fighting from behind. So look, in closing, Pulte isn't panicking. They're conserving. Taylor Morrison isn't chasing, they're calibrating. And Century Communities isn't breaking, they're balancing. The market isn't collapsing, it's testing who actually has a plan, who's adjusting as needed, but ultimately sticking to that plan, because noise sells headlines, but discipline builds empires. And that's what's happening. The big guys are getting bigger, and the small guys are struggling to maintain their market share. When rates finally break below 6, the builders who stayed control will own the next cycle. They'll outlast, they'll outscale, and out-execute everyone still screaming about how the last quarter, the last year was so difficult. Listen, if you want to be one of those who are outlasting, reach out to us. This is what we do here at the Builder's Mindset. We help smaller builders, smaller production builders change their mindset, change their team's mindset so they are ready for the next cycle to take on the big guys who are starting to dominate all the major metro areas. Hey, that's the Builder's Mindset we want to share with you. That's not fear. That's not fantasy. That focus is what we hope to help you understand and implement. So, have a great day. Have an amazing day. And we'll see you next week.
You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.